Operating at an extraordinary level can seem challenging. Learn how to survive in the lone wolf economy in the OG Money podcast with Lonnie Ogulnick. Drawing on over 20 years of experience in the trenches of Wall Street, Lonnie explores what it takes to be successful in today's rapidly changing environment. From daily routines, wealth strategies, and sustaining the highest levels of wisdom, Lonnie and his guests unpack proven ways to live an extraordinary life.
Welcome to the OG Money podcast. Today I have Jason Thompson. He's a portfolio manager at William O'Neill Family Office. William O'Neill is a mentor of mine, someone I studied since 1998. I followed the rules and the system till today. So I'm a 23-year disciple of the O'Neill system. I'm happy to get him on, pick his brain a little bit. Jason, why don't you tell us a little bit about your background and how you ended up a disciple also of the O'Neill system?
Thanks, Lonnie, for having me on. Much appreciated. So I discovered the William O'Neill methodology or the framework for investing a little over 13 years ago when I was a freshman in college. And essentially, I was spending time during a Thanksgiving break with a family, and I was studying biology at the time, and I was really interested in medicine. And they, to make a long story short, they alluded that I should, read Bill O'Neill's work and then consider business as an appropriate source for me to study on a forward-looking basis. So I studied that, and then when I was in college, I interned for a hedge fund that had offices in 2 different locations. I rotated through those locations, and when I was at the first fund that I worked for, one of my assignments or projects to work on was to find disruptive companies. And so naturally, as you know, Lonnie, that fits into the growth or the William O'Neill framework. So I got exposure towards the William O'Neill system and the CanSlim system when I was at that first fund. And then I got brought on to one of the sister companies of William O'Neill to work with them. And then they started a trading academy and then had a feeding method towards bringing up like analysts, junior portfolio managers, sector portfolio managers, and senior portfolio managers, which I currently am now today.
Great. So you talk about the CanSlim method. You want to go over basically what is CanSlim?
I use the O'Neill methodology, which is more of the institutionalized framework of CanSlim. It's just various versions of it, but essentially it could all be bucketed into a growth investing category. So to specifically answer your question, CanSlim is an investment strategy that both deals with stock selection and asset allocation purposes. But at the end of the day, it really tries to find the best performing stocks each cycle. And the entire framework of investing was empirically tested to find the most disruptive companies that have the highest earnings growth, the largest profit margins expansions, and having the largest institutional holders within those stocks. And then what we found over time is they tend to outperform the market. So that's the strategy that tries to captures all of that into a single investing framework.
If we go back 12 years, we would talk about the disruptors, internet names that were eating the world, Amazons of the world. Netflix came on the scene and ate up Blockbuster and everything in its sight. We had Apple just chew up RIM, BlackBerry. They just devoured everything, and they still do. So when you say disruptor, you're talking about the newest technologies in the scene that are changing the way business is done in that specific area. Am I correct?
Yes, that's correct. Now, for the entire an O'Neill methodology framework, about 3/4 of the companies in that bucket are exactly what you said. They're technology disruptors by definition, and that 1/4 of them are turnaround investment companies. But it's the same type of analysis, looking for accelerated earnings, accelerated sales. That's just different business model structures that we analyze.
Yeah, so this cycle, I found myself early, pre-COVID, spotting DocuSign as a preeminent growth name. That was pretty much something I used at work, and I also found it as a tremendous growth play, and I started buying it. I also got involved with Zoom. I got involved with Teladoc very early, and then once COVID hit, I guess 5-year projections got swallowed up this year. Did you find yourself getting involved with those names even before COVID hit?
A little bit. Yeah. I mean, so one of the basis of our framework is to look for high relative strength stocks. And that basically means stocks that institutions are accumulating and that have a 3 to 5 year time horizon. And so when you have a large portfolio and a long time horizon, you're usually gradually building the positions. They tend to take notice of them even when the market is performing bad. Those names that you mentioned, we saw before COVID, and most certainly still looking at them today.
Right. So when you say building them up, I'm a big proponent of the pyramid, adding to positions. Now, how are you guarding against the downside, and what are you doing if a stock you actually really like? Are you using an 8-10% stop loss rule, or are you actually adding to positions?
So we have, on an internal basis at the family office, we have a quantitative dashboard that tracks every metric that you would possibly find useful. One of the metrics that we look at is obviously losses that are relative towards your position size. The O'Neill methodology says take no loss greater than 7%. What I found on a personal basis, my losses average out to around 3%. And that's usually because I'm trading around a position. By the final average of that loss, it turns out to be around 3%.
So you're not going to sort of use a specific rule where, we have a slice through the 50-day moving average. You have, let's call it 1% of your portfolio. You may look at that as an opportunity to add another 1%. But when you average all your positions out, you're saying you're cutting losses at around 3%. That's what you're...
Yeah, that's correct. I mean, that's probably like a second order effect. The first order effect is how are you buying these positions to minimize that negative tail of the distribution and be so tight. The reality is it's a trade-off between portfolio turnover and drawdowns. The mandate that we follow, we would rather have somewhat of a higher portfolio turnover versus having a larger drawdown and an equity curve, or even on an absolute basis. So that's one way to look at it. And then the other angle is that if we're buying a stock and you're selling it up, some up 5% or some up 3% and some down -5 or whatever the average turns out to be, generally we're keeping it pretty tight. Most certainly, I hope to get out of a stock before the average loss is greater than 7%.
What would you say your average hold time is in a position? Do you ever hold a stock for a year or two?
Yeah, I've definitely held a stock for a year or two. Our optimal holding period is based off of model book stocks that we look at, and it's actually between 12 to 18 months. Now, we strive for that holding period, but in practice, it's usually less than that time horizon. For our best winners, it might reach that, but for our losers, we're very quick to cut losses again. So that's why the average is shorter than 12 to 18 months.
Yeah, I'm pretty ruthless with my losses. Every once in a while, if it's a big name, I like to think of like the Amazons when it gives you a 30 to 50% correction. I'll get in there and buy it. But typically speaking, I have a rule. I don't know what your rule is, but I did listen to somebody, I forgot who it was, say that I never had a stock go bankrupt on me above its 200-day moving average. But plenty of stocks go bankrupt under its 200-day moving average. Would you actually get in there and buy stock under its 200-day moving average?
Yeah, that's not going to be within the current mandate that I follow. So I probably will not be buying stocks below the 200-day moving average, because what naturally that probably means is that, one, the market environment is no longer conducive towards our strategy, meaning we're in a bear market, or two, the stock is going through some type of correcting cycle, and we generally try to minimize our exposure towards those type of companies that are going through that process.
Nice. So let me take a step back for a second, because investing weighs on most people's psychological thresholds. Taken to the extremes here, we've had an election recently that's still undecided. We've had numerous impeachments or what have you and everything. What do you do every single day? For me, it's in the morning, but what's your routine like to make sure that you're emotionally and psychologically ready to go in the morning?
Yeah, so I'm probably long on consistency and more short on routine-based things. You know this, lifestyles versus fads and that. I could tell you what works for me personally.
Yeah.
Yeah, so naturally I'm very active and I like a healthy lifestyle. So in terms of peak performance, that's something that I'm very, very aware of. So I know exactly what goes into my body and I know how much energy it requires on a daily basis. So I usually exercise several times a week and I'm pretty healthy with my foods. Used to be a little obsessive about it, but now I think with age and maturity, I've come to relax a little bit. I do, just exercise, strength training, cardio workout. I love to play tennis. I love to cycle. I'm a serial reader. I read every single morning and every single night before I go to bed. That's just something that is now part of my life that I've been doing for nearly a decade now. And it started out of a thirst for feeling very small within the business in terms of how much information that I know. So I'm just constantly reading. And those are some of the things that I do to, stay sharp, as you said it.
So give us a sneak peek. What's the best book? It could be business, doesn't have to be business, that you've read recently.
One of my favorite books that I've read recently would be The Emperor of All Maladies. It's basically the biography of cancer. If you recall earlier, I mentioned I'm very interested in medicine and the entire life sciences and healthcare space. I go through periods where I read in different themes and sectors, but that's just something that I read recently that was outstanding.
I want to talk to you about a topic that I've been very interested for the last couple of years now. Do you ever take a look at Bitcoin and Ethereum and that space at all? I mean, it's back up over 15,000 now, and you got Paul Tudor Jones. You got all the big hedge fund managers now circling the wagons. Are you reading or up on that at all?
Yeah, a little bit. Maybe about 2.5 years ago, I wrote an internal paper for the firm, just looking at alts or alternative strategies. Digital coins and Ethereum and Bitcoin was relevant at the time. So I've on a personal, I don't know what our firm has with that, if anything at all, but on a personal basis, I have very small exposure towards that space.
Have you read anything on it? Have you heard about Michael Saylor and what he's doing at MicroStrategy of late?
Not particularly with that one. I have heard a couple of things and somewhat of a similar realm.
Square's actually bought with their treasury, their corporate treasury. You're going to probably...
Like 50 million, right?
Yeah. It's sort of like, it's an interesting theme. I'm curious as to know why and when the SEC is actually going to allow a Bitcoin ETF. Because like you, I'm searching for an alternative asset class for clients. And for whatever reason right now, they're not comfortable yet launching that. So I find myself looking at things like MicroStrategy as a theme, right? As a theme play, and it's a way to get exposure because they put $450 million into this ETF, well, into their company from their treasury. So I'm playing it like it's an ETF, but it's an individual equity. Speaking of themes, what are some of the themes today that you are actually focused on as a disruptor, and where do you see us this time next year as people are going to be talking about it but haven't really recognized that space yet or those themes?
Something that's probably contrary to what most people believe is because I know software as a service companies are very popular and they've been performing very well. So I'm sure the first order thought on that is that they're probably already priced in for the type of moves that they can make. Whereas I would take a counter argument and say that they're still early on in their product cycles of the companies. And if you look at the reports, the way that the companies are reinvesting and getting back that return on capital and the runway that they have and the relative to the market share capture versus the TAM, a lot of software companies today I have still a long way to go in terms of price appreciation. That space is something that I will continue to focus on, definitely over the next 12 months.
One of the stocks in that space I've done quite well on, a couple of them, but Twilio of late, ServiceNow, but Amazon and Microsoft are also heavily in that space. Am I right?
Yeah, exactly. Those companies are pretty large, so they have exposure towards many different segments. In terms of Twilio, yeah, that's a very interesting company. I think the CEO, Jeff Lawson, runs a really good business. That stock probably needs to correct for a considerable amount of time before it can move higher, but that's a very strong fundamental story. I think APIs will eventually get commoditized, but I think there might be some time before that happens.
You're looking at Twilio from an investment standpoint, right? When you say it needs time to correct, are you looking at from a base building standpoint where over the next 3, maybe 6 months, you're looking for it to consolidate its big move that it's already had? And then will you buy it once it peaks its head back out of its 52-week high? Like, where would you buy that stock again from a technical standpoint?
Yeah, so we have a systematic approach for buying these stocks, and they're all based off of pattern recognition. 70% of our analysis is fundamental base, and then we try to somewhat time our buys and just with a directional approach. Meaning if a stock is trending downwards, we're not going to buy it. But if it's trending upwards, that's when we want to start to build a position.
Thank you for listening to the OG Money Podcast. Click the subscribe button below to be notified when new episodes become available.